Howdy guys, welcome to Financial Analysis Part 2, a continuation of the analysis that we did in Part 1. Today we will focus a little bit more on performance metrics. Alright, just a rough outline of what we're going to cover in today's video includes an overview of what performance metrics are and why they're important. We'll talk about categories of metrics, and we'll spend the bulk of the time talking about examples of performance metrics. Alright, the reason that performance metrics are important is that reviewing just the numbers presented on financial statements does not always provide a full picture of performance. A review of certain performance metrics provides a more thorough analysis. For the record, not all metrics result from financial information. For example, on-time fill rate is a non-financial metric. It can be extremely important and can certainly lead to financial results, though. Some metrics may be key to judging performance. These metrics are often referred to as key performance indicators, or KPIs. Performance metrics are analyzed based on things such as benchmarks. Benchmarks might be an industry benchmark or a company average or some number that you're trying to hit. And then you can grade yourself as being at that number, below that number, or above that number. Metrics are also analyzed based on trends. So, in other words, you analyze it and you look, is the number getting better or is it getting worse over time? And can you explain why that happens? Performance metrics can be used by creditors to decide whether to loan money to a particular company or to continue to loan money. Owners trying to make the decision of whether to invest or not invest in companies. Customers and suppliers trying to decide whether to partner with a company. And also managers. Managers use metrics to look for areas of improvement and areas to focus on to make the business perform better. Performance metrics may fit into one or more of the following categories: safety metrics, customer service metrics, liquidity and risk metrics, growth metrics, gross margin metrics, operating expense metrics, accounts receivable metrics, inventory metrics, accounts payable metrics, cash cycle metrics, profitability metrics, and other categories of metrics. As stated, metrics may fit into one or more categories. For example, fill rate would be considered in an inventory category, but would also be considered a customer service category. Some metrics may be internal only, and we'll discuss some of those. So in other words, even publicly traded companies that are required to publish their financial statements are not required to publish all information. Some of these metrics would be really important internally to measure, and we'll talk about those here. But if you're doing an analysis of a company from the outside, you probably wouldn't have access to that information. We'll identify those metrics as internal in this video. The first category of metrics we'll explore are safety metrics. Unfortunately, accidents happen. It's important to track safety metrics and make sure the organization is operating in a manner that protects our employees and the other stakeholders of our company. Some examples of safety metrics include deliveries per accident, the OSHA recordable incident rate, which an OSHA recordable incident, some example of that would be something requiring medical attention beyond standard first aid. There are other aspects of an OSHA recordable incident rate, but that's just an example. OSHA lost time rate, where an employee actually loses time at work due to an incident. And then the OSHA restricted or transfer rate, which involves an employee not being able to perform their normal job duties due to an incident that happened at work. These aren't all the safety metrics by far, but these are just examples. And of course, these are typically internal rates our internal metrics due to this is not necessarily data that someone outside the company would have. But internally, we would measure this just to make sure we're, again, operating in a safe manner. Customer service metrics, like safety metrics, aren't really financial metrics, but can certainly lead to financial results. Some of the customer service metrics we should be paying attention to are things such as on-time delivery. So what percentage of our orders are we delivering to our customers on time? Number of complaints received over a certain period of time. Back order percentage. How often we're having to back order items. Fill rate. Fill rate may also be an inventory metric, but is a customer service metric as well. And then the Net Promoter Score. While these are typically internal rates that we use to track and make sure that we're meeting our customers' expectations, some of these could be external as well, and the fact that our customers could be tracking those as well. Liquidity metrics are in essence risk metrics, but specifically we're looking at how well a company is managing its cash flow and being able to and has the ability to meet its short-term obligations. One of the metrics that we would consider here is working capital. Working capital equals current assets minus current liabilities. If you remember from an earlier video that current assets are all assets expected to be converted into cash within a year. Current liabilities are all liabilities expected to consume cash within a year. So ideally speaking, we would want our current assets larger than our current liabilities. Now, there is something to be said about utilizing liabilities to help generate returns. We'll talk more about that when we get into some other ratios, but when current liabilities are greater than current assets, it does present a certain level of risk to the organization. So here, when we're looking at working capital, we would hope that that number is positive, that the current assets will be greater than the current liabilities. Another way to look at this is the current ratio. The current ratio is current assets divided by current liabilities. Here we would expect or hope that that number would be greater than 1. Another ratio to consider is the quick ratio. The quick ratio is, at least how it's presented here, is cash plus cash equivalents plus accounts receivable divided by current liabilities. The main difference between the quick ratio and the current ratio is that we're not taking into consideration inventory to meet our short-term obligations. So in other words, we're looking at the things that could actually generate cash in a quicker manner. Typically, inventory takes a little bit more time to sell and to collect. Sometimes you'll see the quick ratio presented as current assets minus inventory, and then sometimes current assets minus inventory and minus prepaid expenses. All of this, the denominator continues to be current liabilities. Another metric that's not really a liquidity metric but does play into the idea of analyzing risk is financial leverage. Financial leverage is total assets divided by total equity. To get the best way to explain this, think about the idea if you were buying a house, it was a $200,000 house. You put $20,000 down, or I'm sorry, if you put 20% down, which would be $40,000. So you put $40,000 down, but you have a $200,000 asset. So basically it would be $200,000 divided by $40,000, which would equal 5. So your financial leverage in that instance would be 5. So for every dollar you invested, your money, you have 5 times that from an asset perspective. Financial leverage can be good. We like the concept of utilizing bank loans or credit to ramp up the total assets that we get to manage. But if that number gets too high, it gets to be a risk as well. So that's a number that we like to track and watch. It's important for a company to demonstrate their ability to grow. Growth metrics help us analyze how well a company is or is not achieving that goal. There's a lot of different growth metrics to consider. The first one we'll look at is revenue growth percentage. This could be considered top line growth or sales growth. The way we calculate that is take our current year revenue minus our previous year revenue divided by our previous year revenue. And that'll give us our revenue growth percentage. Another growth percentage to consider is our EBIT growth percentage. EBIT stands for earnings before interest and taxes. Generally speaking, that's considered to be our operating profit. So this, in essence, is our operating growth percentage. To calculate that, we take our current year EBIT minus our previous year EBIT and divide that by our previous year EBIT. So these are two examples. There's others that you could consider, like EBITDA growth or maybe net profit growth. You could consider gross margin growth. Generally speaking, of these two, if we're talking about revenue or some type of profit number, if I asked somebody which one was more important, I think most people would probably agree that they would rather grow profit without growing revenue than grow revenue without growing profit. And I think that would be a fair assessment. However, it's important not to lose focus on revenue growth percentage. If you read in the Wall Street Journal that company XYZ had grown by 15% from last year, most people agree that they would be talking about top-line revenue. So it generally gets the most focus. And a lot of that is because it demonstrates a company's ability to either grow as its market is growing or to take market share away from competition. And when it comes to meeting some of the other metrics that we need to meet in the future, our ability to grow can help achieve some of that. And so we basically want to be able to prove that we are in a growing market, or we at least are a growing company. Another factor to consider is what we refer to as unit growth percentage. Now, I'll just kind of talk about this, and then we'll come back and, or I'll describe the formula, and then we'll come back and talk a little bit more about it. But basically, to calculate this, you have current year units minus previous year units divided by previous year units. And where this might come into play is maybe in a particular industry where they have a lot of price fluctuations, maybe up and down. And so here you might track a particular unit in that market. For example, if you're in a lumber business, maybe you track board feet or square feet of product that you moved or something like that. Generally speaking, this would be considered an internal number oftentimes. Probably can't look at somebody's financials and really determine that in the way this formula is written anyway. You know, from the outside looking at published financial numbers. Another way to calculate this, though, would be to basically adjust for that price fluctuation, or I'll say inflation rate. And the way we do that is we'll take our current year revenue, divide that by 1 plus whatever we estimate that inflation rate to be. So for example, if we estimate it to be 3%, we take our current year revenue and divide it by 1.03. From there, the rest of the formula kind of looks like your revenue growth percentage minus previous year revenue and then divide by previous year revenue. And that gives me a better idea of how much product I'm actually moving, or the growth of how much product I'm actually moving. Gross margin is one of the most important numbers that we look at in distribution. To calculate gross margin, we would simply take revenue minus cost of goods sold will give us our total gross margin, or gross margin for the period, or whatever it may be that we're looking at. But will give us our gross margin dollars that we're looking at. Sometimes this is referred to as gross profit as well. The numbers can really be used interchangeably for the most part. But the reality of it is a better, more descriptive name for what it is gross margin. So we'll refer to it here as gross margin. Another gross margin metric that is important to track is our gross margin percentage. Here we take revenue minus cost of goods sold divided by revenue. That will give us our gross margin percentage for the time period that we're looking at. And we could also calculate this on an individual item. We basically take our sales price minus our cost of goods sold divided by our sales price. Would give us our gross margin percentage on that particular sale. Now, there's a lot of different ways that we can improve gross margin. One of the ways we improve gross margin, obviously, is by growing. So, like we looked at earlier, you know, if we can sell more, that will we keep our pricing and what we're paying for the items the same, then our gross margin dollars will go up. Another way we can improve gross margin dollars and improve gross margin percentage is raise our price without losing business. When we're able to do that, our revenue goes up, but our cost of goods sold stays the same. And then another way that we can improve that is by negotiating better with our suppliers, or just buying better in general to get a lower cost of goods sold, which can improve both of these numbers. In addition to the metrics we're looking at here, what we'll see on some of the coming slides, we will see that gross margin becomes a very important part of some of the other metrics that we'll be looking at. Operating expense, or OpEx for short, these are expenses necessary or due to the fact of the type of business that we have chosen to operate, or what basically expenses it takes to take care of our customers. So, for example, here mostly we're talking about distribution. These would be the expenses related to distributing products, both personnel-related expenses, such as salaries or sales commissions, and non-personnel related expenses such as fuel expense, warehousing expense, and such. There are other expenses associated with a company that are non-operating expenses. Some of those are like interest expense. Interest expense may be necessary to be in business, but not necessary to service our customers. One of the first metrics we'll consider from an operating expense metric is OpEx as a percentage of sales. Here we just take our operating expenses and we would divide that by revenue. So typically we're looking at total operating expenses or total revenue for the period in consideration. And that'll basically give us that percentage. So generally speaking, we would expect as our revenue goes up, our operating expenses will probably go up some amount due to the fact that some of our expenses will be tied to the movement of more product. And if we're selling more, then we're probably moving more items. And so we want to have an idea of what that ratio is, because if it gets out of whack, that might tell us, hey, our revenues are really down, but we haven't adjusted our expenses down enough to match that. A wise CEO of a company told me one time that really operating expenses is the only thing that you fully control. And it may not be true that you fully control it, but you probably do have more control over your operating expenses compared to just about any of the other types of metrics that we look at for various reasons. Another thing to look at is our OpEx as a percentage of our gross margin. So here we're looking at our total operating expenses divided by total gross margin for that period. And that's basically going to tell us how much of our gross margin is being used up in operating the company from an operating expense standpoint. A couple other metrics to look at. The first one, a really common metric that a lot of, from an internal perspective, that people considered is what we call the personnel productivity ratio. Here we're going to total up all employee costs, all costs related to the employees. That's going to be salary, benefits, taxes that we pay, and then divide that by gross margin dollars, which basically tells us how much of our gross margin dollars is being used to pay or because we have employees. The inverse of that is actually a little more interesting in my opinion to consider. So the PPR, personnel productivity ratio, is a really, really common metric in distribution, but I think the inverse really tells the story a little bit better what we're trying to get. And we refer to that as our personnel productivity multiplier. And if you'll notice, it literally is just an inverse. Here we put gross margin dollars on the top and divide that by all total employee related expenses. And what this tells us when we're done is it tells us for every dollar we invest in our people or in people related expenses, how much gross margin dollars do they achieve? And so while it really kind of tells us the same thing, I think it tells the story a little bit better in that we would want to improve our personnel productivity multiplier because as we improve our employees' ability to generate gross margin dollars, it should help us achieve a lot of our other goals. The PPR and the PPM, the personnel productivity ratio and personnel productivity multiplier, generally would be considered an internal number due to the fact that in total employee cost is not generally something that is made available in published financials that go out to the general public. The next section we'll look at is accounts receivable metrics. Accounts receivable, as a reminder, is the money that other people owe us. Generally speaking, from a distributor standpoint, this is for products or services or services that we've provided, that we've extended credit, given customers a certain amount of time to pay for that. Sometimes there's other things in that as well, but from a distributor standpoint, the bulk of that is going to be from that, which is sometimes referred to as trade payables. But we're going to make the assumption that the accounts receivable is made up of all of that for these metrics. The first metric we'll look at is Days Sales Outstanding, or DSO. The way we'll calculate that, we'll talk about the denominator first. We're going to take our annual revenue and divide that by 365. When we do that, we'll come up with an average amount that we sell every day of the year. You might not be open 7 days a week, probably not open on holidays, but on average, how much do we sell every day of the year? And then we're going to divide that number into our current accounts receivable. When we divide that in, that's going to tell us right now, on average, when we sell something, how long it is before we collect it. Another accounts receivable metric to consider is our gross margin return on accounts receivable. Here we're going to take the total gross margin generated for a particular period. Usually we're talking about a year here. So take our total gross margin generated for the year, and then we want to average or divide that by our average accounts receivable. And our average accounts receivable, a lot of different ways you can calculate an average. You can take the amount at the end of each month, add that up, divide by 12 because you have 12 data points. Or you can take the beginning of the year and the end of the year, add those up and divide by 2. That would give you, generally speaking, roughly what your average accounts receivable is. What we're looking at here, what this number is telling us, is how well we're using credit that we extend to our customers, which turns into accounts receivable, how well we're using that investment to generate gross margin dollars. Inventory metrics. If you are working in the distribution business, I don't have to tell you how important it is to manage inventory. In fact, it is usually either the first or second largest asset on most distributors' books. It's usually between that and accounts receivable. There's a lot of metrics we could consider when it comes to inventory, because one of the goals of a distributor is to be extremely good at managing inventory. With that comes a lot of experts that have studied the topic, and as they've studied the topic, they've come up with a lot of different metrics. We're going to consider 3 metrics here. The first metric we're going to consider is inventory turnover, or inventory turns. Here we're going to take our total cost of goods sold and divide that by average inventory. Now we're making an assumption here that all of our cost of goods sold kind of goes through our warehouse, or that we're using direct sales potentially as to help us benefit this number, because those don't typically go into average inventory. Either way, as long as you're consistent with it, if you use total cost of goods sold or you use just total cost of goods sold that comes through your warehouse, to be from an analysis standpoint, I like total cost of goods sold, because if I'm looking at a distributor's publicly traded financials, I may not necessarily have that number of how much went through the warehouse and how much went direct. So again here, our inventory turnover or inventory turns equals total cost of goods sold divided by our average inventory. It's a very, very common metric in distribution, one of the most common metrics I believe out there. Sometimes I think there's too much reliance on inventory turnover. I think it's an extremely important number. The more you can turn your inventory, the better return you give your shareholders. However, the number in and of itself doesn't actually generate a return. So we want to keep it in mind. We want to use it. We can use it again to compare, as we said earlier, to benchmarks or trends, but we don't want to be over-reliant on that number. A couple other things to look at. A very similar number, these numbers will usually be tied together pretty well, is our days of inventory. So our days of inventory, what we're looking at here is, again, I'll look at the denominator first. Take our total cost of goods sold, divide that by 365. That's going to give us an idea, or it's going to give us basically an average of how much we sell from a cost of goods sold perspective every single day. And then we take that and divide it into our current inventory, and it tells us right now the amount of inventory that we have on the shelf, how long, or on average really, from the time we receive an item, how long is it before we actually sell that item. So that's what our days of inventory gives us. Another metric that I think most distributors really should ratchet up what they look at, or in consideration of how well they're managing their inventory, is what we refer to as gross margin return on inventory investment, or you may have heard of it as GMROI. And here we're going to look at our total gross margin dollars generated for the period, usually we're talking about a year, and divide it by the average inventory for that year. And that's going to basically tell us how well we're doing utilizing our inventory to generate gross margin dollars. Accounts payable is mostly made up of the amount of money that we owe our suppliers for products that we purchase from them, that they've extended us credit or given us a period of time to pay for. The more time that we can negotiate, the longer out that term is, the higher our accounts payable will be. So while accounts payable is a liability, in fact it's a current liability, which if you remember from the liquidity portion of this video, we talked about wanting current assets to be greater than current liabilities. So granted, we want current liabilities to be less from an analysis standpoint. However, from a distribution standpoint, this is the only interest-free debt we generally can have. This is our suppliers' portion, our suppliers helping fund the movement of the product through the supply chain. And again, the better supply chain partner we are, the better we can negotiate longer credit terms or payable terms. So there's a couple of things that we're going to look at in this. One of the things we're going to look at is what we refer to as our days payable outstanding, or our DPO. Similar to some of the other metrics we've done up to this point, we take our total cost of goods sold for the year, our annual cost of goods sold, and divide that by 365 to get an idea of how much product we're moving every day from a cost of goods sold standpoint. And then we're going to divide that into our accounts payable. When we divide that into our accounts payable, it's going to tell us right now, on average, from the time I receive an item, how many days is it until I pay for that item? That's what our days payable outstanding is telling us. Another metric to consider is our accounts payable as a percentage of inventory. So here we want to take like our average accounts payable, or you could do current, but calculate it as a current number as an average number. But generally speaking here, I want to look at on average. So I look at average accounts payable, and a lot of different ways you can calculate an average. Again, I can take the amount at the end of each month and add them up and divide by 12, or the end of each quarter, add it up and divide by 4, or I can take the beginning and the ending, add those up and divide by 2. But I can take my average accounts payable, divide it by my average inventory. This is going to tell you on average how much your inventory is being funded by your suppliers. Cash cycle metrics include some of the metrics that we've already looked at that we'll review again real quick here. So for example, days of inventory, or DOI, remember, is the amount of time from the time we receive an item until we sell the item. Our day sales outstanding, if you remember, is from the time we sell the item till the time we collect for the item on average. And our days payable outstanding tells us, on average from the time we receive inventory or an item until the time we pay for that item. So our cash conversion cycle then is our days of inventory plus our days sales outstanding minus our days payable outstanding. And when we're doing this, we can look at average numbers such as average inventory, average accounts receivable, or average accounts payable, or we can look at what the current number is to come up with whether we're trying to determine what our average cash conversion cycle is, or we're trying to look at what our current cash conversion cycle is. So again, you can use current numbers, you can use average numbers. This one is really better represented like this. So generally speaking, from the time we receive an item until we sell the item, that's our days of inventory. From the time we sell it then until the time we collect it, that's our days sales outstanding. And again, from the time we receive it until the time that we pay for it, that's our days payable outstanding. So cash conversion cycle is days of inventory plus days sales outstanding minus days payable outstanding, which basically means it's from the time that we pay for it till we collect it. That's our cash conversion cycle. Think of it as cash to cash. Just a quick example on this. If days of inventory is 60 days, days sales outstanding is 45 days, days payable outstanding is 30 days. 60 plus 45 is 105 minus 30 would equal 75 days cash to cash. This is the amount of time that you as the distributor are financing your working capital. And we can improve this number. So when we talk about improving inventory turns or days of inventory, or we talk about improving receivables or payables, it's really best to look at these all collectively as well, how they're all working together. So if I can turn my inventory more often, or I can collect from my customers sooner, or I can negotiate longer payment terms with my vendors, all of those will improve the cash conversion cycle. With profitability metrics, we're trying to measure not just profit, but our ability to earn that profit. So we're looking at profitability. We will look at metrics that have to do with generating profit, but we also need to take into consideration the resources that are necessary to generate their profit, or how well the company is utilizing those resources to generate profit. One of the first metrics we'll look at is asset turnover. Here we'll take total revenue for the period, usually a year, and we divide that by our average total assets. And what that basically tells us is how well we're utilizing our assets to generate revenue. Another metric to take into consideration is operating income percent. Basically take your operating income and divide it by revenue for the period. And what that tells us is basically how much of that revenue we're able to put down into operating income or operating profit. Another metric to consider, it's really gotten popular over the last, I'd say, 10, 15 years, is EBITDA. EBITDA equals our net profit before tax plus our interest plus depreciation and amortization. Basically, it's our earnings before we deduct interest, taxes, depreciation, and amortization. The reason EBITDA has become really important is it can serve as a good proxy for cash flow when we're making valuation estimations of companies, especially different operating companies like a distributor is. And just to clarify there, when we talk about a proxy for cash flow, it's not necessarily an estimate for cash flow. It's just a number that I can use to compare one company to another to get an idea of their valuations. Another metric to consider is return on total assets. Here we take operating profit and divide that by average total assets. You could also do this with net income if you wanted to. It depends on what you're trying to achieve. As long as you're consistent with it, But basically what this is telling us is how well we're utilizing our assets to generate a profit, either operating profit or net income. Another metric to consider, especially if I am trying to gauge a particular operation or division or portion of the operation within the business, is going to be return on net assets. What net assets are basically your total assets minus your current liabilities. Some people would just say total assets minus accounts payable. Here we're basically just trying to encourage the operator to utilize accounts payable as much as possible. So for example, the formula would be for return on net assets would be operating profit divided by the average of total assets minus current liabilities. Another metric to consider, and this is more as a whole company judgment, is return on equity. Return on equity, generally we're going to focus on bottom line income, so we would take net income divided by equity, or net equity, which is usually total assets minus total liabilities. So the formula would be net income divided by the average of total assets minus total liabilities. All right, just to summarize, we talked about overview of performance metrics, spent a little time on categories of metrics, but spent the bulk of the time discussing examples of metrics. And if this video is on YouTube, I think I'm supposed to ask you guys if you're interested in the material of this and would like to know more as we upload new videos, please subscribe to the channel. Thank you.